Green bonds are a fascinating financial instrument that's gaining traction in the fight against climate change. Essentially, they are fixed income securities specifically earmarked to raise funds for projects that have positive environmental impacts. Think of them as a way for investors to put their money where their values are, supporting initiatives like renewable energy, energy efficiency, and sustainable agriculture. The concept of green bonds emerged in the early 2000s, but it really took off around 2010 when the World Bank issued its first green bond. Since then, the market has exploded. In 2020 alone, global green bond issuance reached over $270 billion, and it continues to grow as more investors seek sustainable options. This growth reflects a broader trend: the increasing recognition that financial markets can play a crucial role in addressing environmental challenges. One of the key features of green bonds is their transparency. Issuers are required to provide detailed information on how the proceeds will be used, which helps investors track the impact of their investments. This transparency builds trust and encourages more capital to flow into green projects. For instance, if a city issues green bonds to fund a new solar energy project, investors can see exactly how their money is being utilized and the environmental benefits that result. The benefits of green bonds extend beyond just environmental impacts. They can also offer financial advantages. Many investors are now considering environmental, social, and governance (ESG) factors in their investment decisions. Green bonds often attract a diverse range of investors, including institutional investors who are increasingly focused on sustainable investment strategies. This demand can lead to lower borrowing costs for issuers, making it an attractive option for governments and corporations alike. However, the green bond market isn't without its challenges. One major issue is the potential for greenwashing, where companies might label their bonds as green without substantial environmental benefits. To combat this, various standards and certifications have been developed, such as the Green Bond Principles and the Climate Bonds Initiative. These frameworks help ensure that the projects funded by green bonds genuinely contribute to sustainability. Another challenge is the need for more standardized reporting and metrics to measure the impact of these investments. Investors want to know not just that their money is going to green projects, but also how effective those projects are in reducing carbon emissions or enhancing biodiversity. As the market matures, we can expect to see improvements in reporting practices, making it easier for investors to assess the true impact of their investments. In conclusion, green bonds represent a powerful tool for financing the transition to a more sustainable economy. They align financial returns with environmental responsibility, creating a win-win scenario for investors and the planet. As awareness of climate change grows and the demand for sustainable investments increases, the green bond market is poised for even greater expansion. By investing in green bonds, individuals and institutions can play a vital role in funding the projects that will shape a more sustainable future.